Mastercard just dropped a massive Q2 earnings beat. Revenue is soaring, cross-border spending is exploding, and margins are holding near 60%. But is the stock still a buy, or are there warning signs hiding beneath the surface? Let's break it down. Founded in 1966, Mastercard operates one of the world's largest payment networks, enabling credit, debit, and prepaid transactions for consumers, businesses, and governments. The company generates revenue primarily from fees on transactions processed through its payment network and from licensing its brand to financial institutions that issue Mastercard-branded cards. Mastercard also offers value-added services, including fraud prevention tools, data analytics, and cybersecurity solutions. The company currently offers a starting dividend yield of 0.54%, slightly below its 5-year average of 0.56%. The price-to-earnings ratio stands at 32, compared to a 5-year average of 33, while the current sector average is significantly lower, around 11.3. Based on current estimates, the expected fair value range for the stock is between $518 and $633. With the stock currently trading around $560, Mastercard appears to be fairly valued at today's price. Mastercard pays an annual dividend of $3.04, distributed quarterly. The next dividend payment will be on August 8th, and shareholders who own the company's shares by July 9th at the latest will be eligible for it. The most recent dividend increase was 15.2%. The average increase over the past 5 years is 14.5%, and the average dividend growth over the past 10 years has been 18.8%. Additionally, the company has paid and raised its dividend every year for the past 13 years. The earnings payout ratio and free cash flow payout ratio are both at very low levels and have even been on a declining trend for a few years despite the high dividend increases. Earnings and free cash flow per share have been steadily growing year over year, with a slight dip in 2020 due to COVID, which is not surprising. Earnings per share has been growing comfortably above 10% annually, and the same can be said for sales. The company continuously buys back its own shares, which is something long-term investors appreciate, and the total sales chart also shows strong year-over-year growth. Return on equity and return on invested capital have been at impressive highs over the past 10 years. The same applies to operating and free cash flow margins. Net debt to EBITDA is at very low levels, while net debt to capital has been above the preferred 0.4 threshold over the past 5 years. However, interest coverage remains at very healthy levels. Mastercard is currently available with a starting dividend yield of 0.54%, and the most recent dividend increase was 15.2%. The credit rating is A+, and the dividend appears to be very secure. I believe the company can continue to raise dividends by over 10% in the future. Since it is currently purchasable at a fair price, in 10 to 20 years, it could generate a substantial return thanks to its high growth potential. At that point, it may also be worthwhile to hold the shares for the dividend alone, due to the huge yield on cost. Disclaimer: this video is for informational and educational purposes only. It does not constitute financial advice. Always do your own research before making any investment decisions, and never base a financial decision solely on the content of this video. Now, let's go over the positive and negative aspects of Mastercard's latest earnings report. Net revenue, $8.13 billion, up 16% year over year on a currency-neutral basis. Adjusted operating income, $4.87 billion, up 17%. Adjusted EPS, $4.15, a 14% increase. Operating margin, 59.9%, up 0.5 percentage points. Share repurchases, $2.3 billion in the second quarter, plus $1.0 billion through July 28th. Why it matters. Growth was driven by a strong payment network, value-added services, and foreign exchange volatility. EPS got a boost from share buybacks, but was slightly offset by a higher effective tax rate, 20.9%, due to global minimum tax rules. Gross dollar volume, GDV, and payment activity. Worldwide GDV up 9% year over year. US up 6%, debit up 7%. International up 10%, credit up 9%, debit up 11%. Cross-border volume up 15%, driven by travel and non-travel cross-border spending. Significance: cross-border transactions are high margin for Mastercard. The continued strength here, especially in travel, indicates solid consumer activity and global economic resilience. Transactions and cards. Switched transactions up 10% year over year. Total Mastercard and Maestro branded cards 3.6 billion globally, up 6%. Contactless share of in-person purchases 75%. Why it matters: this shows strong adoption of digital payment infrastructure and behavioral shifts toward tap-to-pay, especially post-pandemic. Mastercard benefits from this trend in both volume and efficiency. Revenue segments breakdown. Payment network. Revenue up 13%. Value-added services and solutions up 22%, approximately 4 percentage points from acquisitions. Growth drivers: cybersecurity, digital authentication, customer engagement solutions. Analysis: Mastercard is evolving beyond just a payments network into a high-margin tech-driven services provider. This diversifies revenue and supports margin expansion over time. Key metrics: payment network. Domestic assessments up 9%. Cross-border assessments up 15%. Transaction processing fees up 18%. Other network assessments $260 million. What this shows: revenue is growing faster than volume in some categories, thanks to pricing, foreign exchange volatility, and favorable transaction mix. Strong performance across nearly all network-based metrics. Operating expenses. Total adjusted operating expenses up 14% currency neutral, G&A up 13%, marketing up 23%, D&A up 14%. Acquisitions contributed approximately 4 percentage points to expense growth. Interpretation: spending is strategic, aimed at infrastructure hardening, global expansion, product enhancements, and cybersecurity. These are investments in long-term competitiveness, not short-term inefficiency. Regional and market trends. Some slowdown in cross-border travel growth in Middle East and Africa due to geopolitical tensions and tougher comps. Cross-border CNP, non-travel, remains strong, with approximately 20% year-over-year growth. July trends. Volumes and transactions remain stable post-second quarter. Why it matters: despite minor softness in select regions, broad-based consumer demand remains intact. Mastercard's geographic and segment diversification cushions regional fluctuations. Positives and negatives. Overall, Mastercard delivered a very solid quarter with several strong positives worth highlighting. Revenue and earnings per share both showed robust year-over-year growth, underpinned by strong performance across their core payment network. One of the biggest tailwinds continues to be the strength in cross-border and online, card-not-present volumes, areas that typically offer higher profitability for the company. In addition, the company's value-added services segment continues to expand rapidly, contributing to margin stability and long-term growth diversification. The continued share repurchase activity, $3.3 billion total through July, also supports shareholder value and helped lift EPS. Operating margins remained near 60%, which is exceptional for a company of this scale and reflects disciplined cost control alongside revenue momentum. On the flip side, there are a few areas of concern to keep an eye on. The company's effective tax rate rose significantly to 20.9% due to the implementation of global minimum tax regulations, which had a slight drag on net income growth. Operating expenses also increased meaningfully, driven partly by recent acquisitions and higher investments in technology infrastructure. While these are strategic, they do weigh on short-term margins. Regionally, there was some softness in cross-border travel volumes in the Middle East and Africa, primarily due to geopolitical factors and tough year-over-year comparisons. Lastly, ongoing foreign exchange volatility continues to impact visibility and predictability in certain revenue streams, especially in transaction processing and international segments. Despite these challenges, Mastercard's fundamentals remain strong, and its strategic positioning continues to support long-term value creation. But now I want to hear from you. Do you currently hold Mastercard shares in your portfolio? And based on these latest results, do you think MA stock is a buy at today's price, or is it already priced for perfection? Let me know your thoughts down in the comments. I read every one. What if I told you there's a company that earns money every time someone swipes a card, without ever taking on any debt or lending a single dollar? This company processed over $3 trillion last quarter alone, and chances are you used its services today without even realizing it. Today, we're diving deep into Visa, one of the most powerful yet misunderstood businesses in the world. Founded in 1958, Visa runs a global payment network that processes credit, debit, and prepaid card transactions. Unlike banks, it doesn't issue cards or extend credit, but earns fees for transaction processing, including authorization, clearing, and settlement. These fees are typically a small percentage of each transaction. Visa also collects service fees from financial institutions based on card usage and generates revenue from cross-border transactions involving different currencies. Visa currently offers a dividend yield of 0.67%, slightly below its 5-year average of 0.73%. The stock is trading at a price-per-earnings ratio of 29.2, compared to its 5-year average of 27.6, and well above the sector average of around 12. Based on valuation models, the expected fair value range for Visa shares is between $299 and $365, while the stock currently trades at around $351. This suggests that Visa is fairly valued at the moment, neither significantly overvalued nor undervalued. Visa currently pays an annual dividend of $2.36, distributed on a quarterly basis. The next dividend payment is scheduled for September 2nd, and to be eligible, investors must own the shares by August 11th at the latest. Visa's most recent dividend increase was 13.5%, compared to a 5-year average growth rate of 15.4% and a 10-year average of 17.7%. The company has a strong track record, having paid and increased its dividend every year for the past 16 consecutive years. Both the earnings payout ratio and free cash flow payout ratio remain consistently low year after year, despite Visa's aggressive dividend growth. It's no surprise then that both earnings per share and free cash flow per share have been steadily increasing over time. While 2020 was a weaker year due to COVID, the company has since returned to form, delivering EPS growth of around 15% annually. The sales growth chart also reflects this strength, showing consistent growth in the 10 to 11% range. Visa continues to buy back its own shares, which is something long-term investors highly value. And because total sales are also rising, the company is able to raise its dividend by approximately 15% annually without meaningfully increasing payout ratios. Both return on equity and return on invested capital are not only high, but trending even higher, consistently exceeding the 10% benchmark, which is very encouraging. Furthermore, operating margin and free cash flow margin have remained well above expectations over the past decade. Visa's management also handles debt extremely well, with the interest coverage ratio comfortably exceeding standard benchmarks for the past 10 years. Visa currently offers a starting dividend yield of 0.67%, and its most recent dividend increase was 13.5%. The company holds a AA- credit rating, which is considered very strong, and its dividend appears to be extremely safe. Based on current valuation, Visa seems to be fairly priced, especially for those with a long-term investment horizon. In the short term, it's clearly a growth stock, but over a 20-year period, with consistent dividend increases like these, investors who start buying now could receive a substantial yield on cost in the future. In my view, Visa still holds massive long-term potential. Now let's go through the company's latest quarterly earnings report together. Net revenue, $10.2 billion, up 14% year over year. GAAP net income, $5.3 billion, up 8%. Non-GAAP EPS, $2.98, up a massive 23% year over year. This shows strong operating leverage, especially when earnings outpace revenue. Payments volume up 8%, cross-border volume excluding intra-European Union up 11%. Total processed transactions up 10%. That's incredibly healthy growth for a company Visa's size. Cross-border in particular is crucial. It has higher fees, and its growth points to strong travel activity. In the United States, credit card usage saw 9% growth, while internationally, debit volume jumped by 11%. Visa's diversification across regions and product types helps smooth out macroeconomic risks. Total cards issued, 4.8 billion, up from 4.5 billion. Transactions, over 83 billion in the third quarter. These are massive numbers. The moat is real. Banks and fintech simply can't replicate Visa's scale overnight. Operating expenses rose 35% on a GAAP basis, but only 13% on a non-GAAP basis. Litigation, $615 million. Marketing and personnel expansion. Ongoing tech investment. Adjusted figures show cost discipline, and litigation provisions were one-offs. Free cash flow, $6.3 billion in the third quarter. Returned $6.0 billion to shareholders via buybacks and dividends. That's 95% of free cash flow returned. Visa is a cash cow, and it's rewarding shareholders generously. Data processing, $5.15 billion. Service revenue, $4.33 billion. International revenue, $3.63 billion. Client incentives, negative $3.97 billion. The negative incentives reflect discounts to big banks and partners, but overall gross margins remain extremely high. Fourth quarter revenue expected to grow in the high single to low double digits. Earnings per share growth forecast, high single digits to low teens. Nothing groundbreaking, but very consistent, especially in uncertain macro conditions. So, is Visa still a buy in 2025? Fundamentally, it's one of the most profitable, defensible business models on the planet. The only real threat is valuation, not execution. If you're looking for a high-quality compounder with global scale, high margins, and robust free cash flow, Visa deserves a spot on your watch list. Thanks for watching, and if you found value in today's video, give it a thumbs up and consider subscribing for more smart, long-term investing ideas. Stay patient, stay consistent, and keep building your path to financial freedom. Until next time, take care and happy investing.